This is the Friday, December 5th, 2014 version of the Market Plus segment. Joining us now is Naomi Blohm. Naomi, welcome back.
Hi, thank you.
All right, on the show, we did not have a chance to get to the cotton market. Lead us into your thoughts on what's happening there.
Just a nice, steady grind sideways in that cotton market. It's really trying to find where the global supply is and where the demand is at. So I think it's at a point where it's at just a happy equilibrium, but at the same time, when we see that, it's actually starting to form more of a rounded bottom formation on the chart. So it could maybe trying to be putting in a longer term bottom. Seasonally, it has its move higher soon, but not much to talk about. We had really good export sales the past 2 weeks, so that has given it some support. But in the big picture, there's still a decent supply out there globally, so we're not looking for too much action there, but we're not looking for it to fall apart either.
And it doesn't seem as though cotton's going to have to be fighting to buy too many acres away from beans, or do you think it will?
That's a good question, and I guess I'm not sure is the answer, quite frankly. I just don't know what people in the South are wanting to do with it, so I can try to look into it and find out a better answer for you, though.
Time will tell.
Absolutely.
All right. Well, we've got a question on the show. You mentioned how the stronger dollar was very detrimental on the dairy side as it helped us outprice our competitors over in Oceania. And that leads into Phil in Ontario, Canada's question. No, excuse me. Stephen in Tappahannock, Virginia had the question. He's curious as to when will the dollar value start cutting into exports. You touched on dairy. How about the other markets?
I think it will if the dollar can get through 90. That's the line in the sand. And so this week, the dollar got real close to 90 on the charts, but this was also that swing objective higher. This was it. This was the goal. And 90 has held since 2006. And even it was a big market area price target in 2004. So for a decade, this is a big deal. So we don't have enough news right now to get it to go through 90, like in the next 3 months or even 6 months. We just don't have the news. So my thought is that we see the dollar retreat a little bit, stay sideways, stay firm, because we're still the best game in town and our economy is getting better, but we don't have that big news to take it higher. So I would say like for first quarter, maybe even for second quarter, it's not an issue. It's nice to chat about. It's nice to theorize about. But it's more like what it would do in 2016. That's when it would be an issue if it could get higher then.
Now, what sort of news, as we look out 6 months or a year for that kind of news that could move the dollar, what would be the biggest thing in your opinion that could change that? Central bank news, is that the main determinant?
I think it would be that, but the other thing, I heard that the European Central Bank is going to start a QE program. So if the other countries of the world then start doing things to make their currencies lower, then that really will keep our dollar higher. So I think it would be more of those outside global things in addition to our economy still, kind of percolating along. So, but it's longer term. It'd have to be very much more of a longer term thing.
Okay. Now, as we look out longer term, we've seen some big changes in this past week in the crude oil market. Yeah. We've seen the U.S. become a very dominant player there. Crude, OPEC's not going to change their production. So we're falling down. How far can this crude price fall, do you think?
60 is the target. But that's like same like the dollar, but on the other side of it. So it's a major support area on the charts. 60 to 70 was a lot of places where some of those OPEC countries were saying that they could have a break even. They could figure out how to make it work. So I don't know that we fall apart too much lower than here for the next month or so. That we just now have to reestablish, where the demand truly is. Is the consumer going to pick up and use more? And then also gauge supply. And in Libya, some of their production is going to be coming on too. So that might be something else that affects the market. So we have a whole lot new players going on, and the market has to get itself figured out. So more of a sideways trend seems likely to me as we try to just see what's going on. But boy, it's kind of been nice.
It has. I filled up. It was 246
I know.
when I filled up
awesome.
Outside Central Iowa. I filled up my truck and didn't cry. It's a nice feeling.
For sure.
Now, we've got a number of great questions here from our folks on Twitter. And Derek, at @Derek on Twitter, is curious, what's your outlook for corn and soybean price in the coming year? And since we touched on the old crop during the show, talk to us a little about what you think on the new crop, corn and beans.
I have a pretty strong opinion on corn that we won't go crashing lower between now and April. The reason being the whole 2 billion bushel carryout thing is been beaten to death. We're in the futures market. We're not in the past market. So quit talking about it.
It's here. Adjust.
Right.
Yeah.
Pretty much. So going forward, we have to buy acres. The demand has been proven that when you have cheap corn, countries buy it, end users use it, and they've been gobbling it up. So truly, my outlook, if we can get any sort of a friendly news, slow grind higher, is that we see the March futures go to 450. That's the target. Now that December chart has the same formation as the March chart. They all look the same. Of course, because December has that natural carry to it. If we have the inverted head and shoulders formation flip to the upside, that points to 470 on the December futures. So I do feel that we'll see those targets on the futures price, but it's going to be a slow grind higher to get there. So the key thing that producers really need to be doing now is calling your elevator, call your ethanol plant, and get your order in place for old crop at like 447, just a little bit below 450, and get your order in place for the new crop at like 465 or 466, something like that. Don't be that guy who's like, well, no, it's at 450, I'm waiting for $5. We don't have the news to justify it. We really don't. So unless there is some major weather issue somewhere in the world or even in the United States, those target prices of 450 and 470 is probably as good as it's going to get. And that lets everybody get $4 cash no matter where you live in the country. That's your target. So be aggressive at those market points.
And shooting for those targets lets you take advantage of some basis opportunities, locking in basis throughout this upcoming year.
Yes.
Be more aggressive, I guess, would be the moral of your story.
Cash is king this year, and make sure you do it. Lock it in.
All right. Now, and you mentioned something else interesting on the show with the late planting of the acres in South America. Is that an indication that they will plant less second crop corn and maybe more soybeans as a second crop?
I am not totally sure. I've kind of heard, depending on geographically where things are, it affects corn, it can affect the beans, and it can affect the cotton. So I don't know for sure how it specifically plays out, but it's something that could develop and unfold for some excitement.
Okay. All right. On the bean side, a little more risky in the 15 bean market. Do you have an opinion there?
I really think that we see that marketplace get to like $11 futures. That's kind of where some of the technical objectives are pointing to. The global soybean ending stocks right now are still they're very, very strong. So I think corn is the hotter game in town, with beans following. But again, any weather hiccups along the way, because that bean demand is so strong, we could set ourselves up for something good. So again, take advantage of the winter and early spring rally and be aggressive on your pricing, because after that, you're just hoping for a weather rally to make the market go higher. So who knows?
And that could happen, but
right now,
it's money in the bank
to
take advantage of what's
right
out there. Now, final question. Well, you did a great job. You addressed almost all of our Twitter questions. Naomi, Phil in Ontario, is $4 futures Stonewall? Nope. We'll plow through it eventually. And corn looks to be potentially the more profitable choice for next year. So final question before we let you go. You talked about it on the show. Don at Snarkosaurus on Twitter is curious. Are feeders mispriced? And if so, in which direction?
Ooh. Right now, I don't think that they are, because there are so few of them. But at the same time, that's a market that just will kind of creep higher, and then it looks back to see if anybody's following, or did anybody see what I did? Is it still happening? So the difference will be, though, how the demand keeps up for the fat cattle market and things like that. But with low gas prices, we got the restaurant index at record amounts, and things are looking good. So right now it's not an issue because the demand can keep up, but don't be complacent just in case something happens.
Just in case they
who knows? Yeah, right.
With low numbers, it's a volatile situation. All right. Well, Naomi, thanks so much for taking the time to be with us this weekend.
Welcome.
That wraps up our Market Plus segment. Thanks to all of you for taking the time to watch. Thanks to all of you who sent in questions via Facebook and Twitter. Please continue to do so, and we will get expert analysis right to you. Thanks for watching, and have a great week.